In this week's update, simply a healthy mean reversion in technology. The Fed reaffirms a big policy shift and what it means for investors, and best to remain light on gold stocks. My name is Garry Davis, and as always, this is general advice only. And please remember to subscribe and like the video. Let's start with a brief market perspective. The Fed, a couple of weeks ago, made some announcements, a big policy shift. They reaffirmed that through the week. And that policy shift has huge ramifications for investors. So in effect, what the Fed has done is that they've got a dual mandate around employment and around inflation and price stability. So what they've done is they've shifted the focus to prioritise full-time employment, or full employment, I should say, and not worry so much about the 2% inflation target. In fact, they've said that they actually want to average out 2% inflation over the long term. And because inflation has been well below 2% for quite a few years now, they actually want to run the economy hot for a period to compensate for that. So they're actually trying to push the inflation rate up above 2%. And that can't be a bad thing for gold either at a big picture level. Now, through the week, they released their dot plot, which is just an estimate of all the voting members of the Fed as to where they saw interest rates going over the next 16 quarters. And the vast majority of Fed members saw that interest rates would remain where they are until the end of 2023. There were a couple that thought that interest rates would move up sooner than that, but the vast majority are saying that we're not going to see any rise at all until 2024. So if you think about what that means for investment markets and for investors, I mean, for those of you that have been around the market for a few decades, just think back to the last time you could have said, looking forward, interest rates will effectively not move for the next 3 to 4 years. I can never remember that in my lifetime. It's never happened. And, this really is rarefied air that we're in, I think. Now, the big aggressive buying is not sustainable no matter what sector of the market is and in what time frame you want to look at it, because big aggressive buying brings a certain set of dynamics with it. Because buying power is finite. And so eventually the buying power exhausts itself. That leaves mainly sellers into an overbought market, and then ultimately you get a reversal and markets go back down again. And if you consider what's happened just very recently in big tech, so because of the call buying that I talked about last week, the massive call buying that went on that propelled the FANG stocks and a lot of the technology areas to really excessive levels, and that's now reversing. So just consider that that's a real live example that we've got right now. And also consider what's happened to gold since early July. Gold broke out in early July, shot up very, very strongly throughout August, and then has basically gone into a sideways consolidation zone. So whatever it is, that big aggressive buying is just not sustainable, and that's why you don't want to buy into parabolic moves in the market or in stock prices in general. So this process of aggressive buying, getting way ahead of itself and then reverting to the mean is what's known as a correction. And this happens all the time, and you've got to expect it. And that's why the moves in the American tech stocks were not sustainable. The moves in the gold sector were not sustainable without some sort of correction. Now, corrections can occur in two forms. One form is that we get a sudden sharp downward move, and that happens most of the time. But the other way that a correction can play out is that the price just effectively consolidates at a very high level, and the degree of overboughtness, if you like, just basically gets extinguished by time. And it's possible that that's what's happening in the gold market, but I'll talk more about that shortly. So turning to American stocks, the S&P, I'm not sure I don't think I changed that from last week, so that may not be correct, but we'll just check on that when we get to the chart. So the period that we're in at the moment, so extending back, let's say 2 months, is very much a period of contrived price action. And that price action has come because of this incredible buying that occurred in the US technology sector by the large Japanese investment house called SoftBank and by some others. And also by a lot of retail trading action as well. So normally on the third Friday of every month in the US is options expiry. And so in the few days leading up to that and in the week following, you often get some price action that doesn't make a lot of sense. It's short term. It's just manoeuvring by vested interests, large vested interests. So that always happens every single month. And then every quarter, that move gets more exacerbated than normal because you've got the expiry of not only options, but you've also got futures as well. And it's what's called the triple witching or the quadruple witching. So you tend to see, more of an impact at the end of quarters. Now, this particular quarter has been even more extraordinary because of this incredible call buying. So $4 billion or $4 trillion, I think it was. No, it might have been $4 billion worth of calls on American big tech stocks, which represented in excess of $50 billion worth of stock, was bought up, and that process is just unwinding at the moment. And so you're seeing price actions that are not reflective of the underlying merits of the business. So to a degree, you just want to chill out a bit through this period and don't assign too much relevance to some of the price actions that we're seeing, because it's just the big players using the opportunity to advantage. Now, from my perspective, let's call it the new economy trade, which is all of the new activities in the economy that have been perhaps brought forward by the COVID lockdowns, all the working from home themes, the change in buying behaviours to moving online, all those sort of things have been brought forward. But when you look out over the next 5 to 10 years, this trade is just going to get stronger and stronger. So it's really only just getting started. So, don't think that if you haven't been involved in this new economy, in 5G, artificial intelligence, digital finance, all of those things, if you haven't been involved up to date, that you've missed the boat, then you want to think again, because we're just very, very much at the start of this. I'm convinced that the world won't return to normal, whatever the heck normal is these days, as future outcomes have been brought forward. That these were outcomes that were always going to happen. We were always going to get a progression to more purchasing online, to greater use of mobile technology for payments. All these sorts of things were always going to happen. They've just been brought forward in a rush by the COVID lockdowns. And some behaviours, not all, but some behaviours have changed. So if you're consuming information or media that is telling you that, when the COVID thing goes past, the behaviours will return to normal, then I think you need to treat that with a great deal of scepticism, because some behaviours will not. And those changed behaviours are leading to tremendous opportunities for investors. Now, the US dollar eased just a little bit. It was about 0.4%. And the 10-year yield is slightly higher to 0.7%. But look, it's just bouncing around in this 0.65 to 0.7% area. And given the Fed announcements through the week, it's probably going to stay there for quite a long period of time. All right, let's look at some charts. So we'll start first of all with the big picture. This is the S&P on a monthly chart. And right over here on the left-hand side is 1997. So that's about 23 years of price history. Now, I've covered this before, secular bull markets, secular bear markets, and, I've been challenged and slightly ridiculed because I said when COVID started that we were still in a secular bull market. And how could that be when the world was in lockdown? And I've made the point since that if you apply short-term logic to markets, then quite often you'll get the wrong answer. And whilst I grant you that logically and intellectually it seemed that with the world shut down that we were heading for a bear market, but there are much bigger forces at play here. There is rotation from old economy stocks to new economy stocks, and the markets have marched on. And history shows we got this sudden plunge, lasted a month, and then went straight back up again. So history shows that when you're in a secular bull market, which is what we're in, so this period here from 2000 to 2012, 13, was a secular bear market. And then within that, we had cyclical ups and downs. We are now in a secular bull market. It is not finished. It could run for another 5 years. It could run for another 15 years. I have no way of knowing. But along the way, we will get some significant and sharp pullbacks. But when you're in a secular bull market, as we are in, they are buying opportunities. You just need to have a game plan that allows you to tap into those opportunities. So just a reminder about the big picture there, and don't let logic get in the way in the short term. And this is the S&P, and what I want you to take note of with all of these charts I'm going to show you is just the orientation of the moving averages. So the red line is the 200, the blue line is the 50-day moving average, and the green line is the 20-day. So just look at the orientation, how they are stacked one on top of the other, whether they've rolled over or not, and where the price is in relation to the 20 and the 50. So this is the S&P. We've just dipped a little bit under the 50, but it's all pretty mild price action. If we then look at XLK, which is really the proxy for the technology sector, then you can see that it looks pretty similar, and it doesn't actually reflect the fact that there's a rotation going on from big technology stocks like Amazon and Apple and Google and Facebook into other parts of the economy, and particularly into transports that I'll show you. But just to illustrate the point why the overall index is not really reflecting the weakness, let's go and look at some individual stocks. So let's look at Amazon. So look at the chart of Amazon. So look at the moving averages, and then look at where the price is in relation to those moving averages. So Amazon was one of the stocks that was really bid up in that call buying, and now this is unwinding fairly savagely. But if you look at another large cap stock in the technology space, this is a software company called ServiceNow, which most people probably have never heard of, but it is quite a big enterprise. But look at its price action, much milder, and so we're seeing very much a very stock-specific market. And this is the point that I keep banging the table on every week, because I get questions from people that are related to what the index is doing. And looking at the index these days is almost irrelevant, because underneath the index is an incredible difference in performance, and we'll see that in a number of different ways. Look at the Dow Transports. If you want to have any doubts at all about how the US economy is going, then let's look at what's happening with trucking companies, with railroads, etc., and their profitability, because that's what this chart is reflecting. This is IYT, the US Transportation Index. And basically we're back at all-time highs. And look at the rise that we've had just in the last month or two. Very, very strong with transports. And the results that have come out from companies like FedEx and United Parcel have been, surprisingly strong. So there are parts of the US market that are doing well. There are parts of the US market that are doing not so well. If we look at small caps, let's look at IWM, which is the Russell 2000. Now that is considerably stronger than the tech sector in the short term. So any suggestion that we're at a major market top is just not looking at all the facts and weighing them up properly. All we are seeing is a rotation from technology that had got way ahead of itself. It's a contrived market. It'll find a base fairly soon, possibly even in this week coming, but maybe a little bit longer. And then, life will go back to normal. But the key point here is that it would have set up amazing opportunities. So you need to be ready, because often the windows of opportunity to get into those sort of stocks can be quite small. Now, the other point I just want to make too is on the VIX index. So we've been looking at this fairly regularly. This is the intraday. There's a lot more volatility, but these are based on close prices over the last month. And you can see we had a significant spike when this technology correction started to unfold. We're still at a relatively elevated level at around 26. So this is hardly a complacent market, but you can see as the prices of the Amazons and the Googles and the Facebooks have come down, the index, the VIX, is not going up to reflect that. And again, that tells you that this is just a transient period. Otherwise, the VIX, if this was a more serious top, the VIX would be up somewhere around 35, 40, possibly even above, because people would be fearful. They would be grabbing for put insurance, and that's just not happening at this point in time. All right, let's take a look at some charts. I just wanted to look at the US dollar. So there's DXY, the US dollar index, and not a lot of change. We've really been consolidating since that sharp run down that ended at the end of July, and we've really just gone sideways since then. And as a consequence, the Australian dollar went up, and it's also consolidating and finished out the week at 72 and 3/4. All right, so that's where we finished on the Aussie dollar. The technicals suggest that the US dollar is going lower, which means the Australian dollar is probably going higher. And market forces around the world really are not favouring strength in the US dollar at the moment either. Now, our index gained just 5 points on the week, so it was effectively flat. But look, the message here is that there are so many high growth and high probability businesses in Australia. It's not just that there are high growth. I mean, lots of rubbishy stocks have high growth potential, but they don't ever realise it. You've got to have the two. You've got to have high growth potential, and you've got to have a very high probability that it's realised. Now, what creates that high probability? It's the quality of management. It's a whole raft of tailwinds that the sector has blowing behind it. It's all those sorts of things that go to make a high probability situation. So you've got to have the two. Now, yes, there's going to be volatility because these sort of stocks, investors get excited about them, they pump them up, and we go back to what I said at the start, and that is that aggressive buying leads to a period of correction. You get too overbought, you run out of buyers, and then all you're left with is a bunch of sellers. So there will be volatility, but that doesn't mean that you should stay away. That just means that you require a suitable game plan for you, who you are as an investor. And if you don't know how to go about doing that and achieving that, then find someone that can help you with it. The answer to me is not to stay out of the game. Why waste the opportunity, this incredible opportunity that we've got ahead of us, through inertia? Because you either can't be bothered or you don't know how to do it. There is someone out there that can help you with how to do it. I think this is the most extraordinary decade in history that we've got ahead of us. And I think the decade after that, you're probably going to say the same thing. When you really read a lot about what's happening in the biotechnology sphere, in the 5G artificial intelligence sphere, it is just mind-bogglingly exciting, the things that are going to unfold over the next 10 years. And that, by definition, means a great deal of investment opportunities. You just need to be ready for them. You need to be structured for them. You don't need to, You certainly don't want to just basically play it as it comes, because you'll miss out on the majority of it. So let's just look quickly. In fact, I'll go through all the Australian indices, just so you get a sense of them. So this is energy, and you can see, and I've got some more comments to make on energy when we get to that slide. So you can see the energy sector is in decline. The 50-day is below the 200, the price is below both of them. It's in a downtrend, end of story. And people that are trying to pick the bottom in the energy sector are certainly not playing probabilities. They're playing a guessing game at best. This is the finance sector. It's doing the same thing, closed on its lows. You know, we're almost back to the May levels, which is, you know, only just the initial recovery after the crash, and it's heading down. So, you know, you can apply all the logic you want to the Australian banks and dividends, but that's the reality of the price chart. There's the health sector. Now, it's been going sideways for a while, but that was only because it had such an incredible run up leading into the crash. So the likes of CSL, Cochlear and ResMed, Fisher and Paykel Health, all those sort of stocks propelled this sector up very, very strongly. And so now we're getting a consolidation. It's not going down, but it's not going up either. There's the overall ASX 200, which is really just a compilation of all of these. So you can see again that the 50-day moving average has been unable to breach the 200-day, which is still heading down, and the price is below both of them. So it's hard to see a lot changing in the Australian market when you consider how it's constituted. Here's the materials sector. So this is the BHPs and the Rios of the market. Now, looks a little better. The 50-day is above the 200. The price is about line ball. And this is what you'd expect at this later stage of the economic cycle. The next 5 years should be pretty good for commodities, and particularly with central banks trying to generate as desperately as they can, they're trying to generate inflation. That's a good environment for commodities. So you're likely to find more investment opportunities in the materials sector than you are in the energy or the finance sector. And if we look at small caps in Australia, they're also looking mildly positive. They're certainly doing better than other sectors of the market. All right, let's move on to precious metals. Gold rose $10, finished at 1951. And the reversion to the mean process that I talked about at the start, that applies to gold as well. And it gets amplified by futures speculators as well, because they're using very high levels of leverage. And so often market moves start, and the future speculators can't tolerate too much of a sustained move in one direction. They have to basically throw their chips on the table. Gold investment buying, I talked about this last week. It's still stalled. I checked the numbers again, and they haven't really moved this week. There's been no move back yet into investment buying, and nor there should be, because the excess in the gold ETF market was such that it just takes longer to unwind, for the overboughtness to unwind. Now, compounding that, and this, you know, these are long-term averages, but seasonally, October tends to be one of the weakest months of the year for the gold price. Now, this year it may do something different, because they're only averages. But there is a pretty consistent and reasonably repeatable seasonal trend that October is weak. So we're heading into one of the weaker periods of the year when gold and gold stocks are still, to a degree, overbought. It hasn't unwound yet, that excessive bullishness. So again, just repeating what I said last week, this is short-term only. My views on precious metals longer term have not changed at all, so this is just a short-term observation. Now, I might be wrong on this. I said last week that you really should look to lighten off on gold, take some profits, because I was a bit concerned about the stalling of the ETF buying at a time when jewellery demand was softer than normal, and now we're running into a weaker seasonal period as well. So look, I acknowledge the sector may rise and we should be open to all eventualities. But all we have in the market is probabilities. That's it. We have no certainties, we have no guarantees, we just have probabilities. And that's all that we can play. And when the probabilities are against us, then you should take an appropriate stance. So that's all I'm saying. And right now, to my mind, looking at all things, both fundamental and technical, the balance of risks remain to the downside. That's just how I see it. So I certainly would not be looking to pile into precious metals at the moment. So let's look at some charts. So we'll start with the gold price. In fact, let's start with the silver price. So the silver price is certainly outperforming gold over the medium term. In the short term, it's pretty much line ball. They're pretty much both just going sideways. Let's look at gold on the weekly basis. So this support level here is the major peak from 2011. At comes in around 1912, 1915 in that area, and you can see that we had this enormous surge of buying that took gold out of what was already a pretty steep channel and just really propelled it up. So again, this is unsustainable and it had to correct. Now, will the correction be a move back, a significant move back into the channel and possibly down to the bottom of the channel? Or will that correction play out as effectively a sideways consolidation move above support? We don't know the answer to that yet. Now, let's look at the daily chart. So you can see that we've got a descending triangle that's forming here, right at that support level. So a series of lower highs. Now, often that descending triangle will resolve itself to the downside, but not always. Sometimes it can go to the upside. But I think the one thing we can say is that it's moving towards the apex of that triangle, and therefore it's likely to resolve itself one way or the other, and it could be a violent move. So on the plus side, the price is holding this key support level in the low 1900s, and it's also holding the 50-day moving average. And the 50-day moving average is very important. Technicals are important in the precious metals market, to a degree more so than other markets. So they're the positives. The negatives is that we do have a descending triangle formation, and that could result in a move to the downside. The other thing is that sentiment still remains uncomfortably bullish from my perspective. It hasn't unwound enough. People haven't been, new traders haven't been kicked out of the market and become bearish on gold yet. So I would still like to see that sentiment situation move down before I think it sets up a better probability. So the overboughtness could be resolved by time. It doesn't have to resolve itself by a move to the downside. This could just, sometimes we get to the real apex of the triangle and it just peters out and the price just goes sideways for a few more months. That's possible. But right now, I don't think it's the high probability. I think the higher probability is to the downside, and that's all it is. That's just an observation of probability. It's not a prediction in any way. So for me, I think the technical line in the sand is this 50 DMA, and this level here at 1912, 1915 is important. Because you think about all the people, many of them who were very inexperienced traders who bought that breakout. It was a major breakout that they bought into. You think about what they're going to do if this breakout level fails. They're not long-term investment buyers. They're momentum traders. You might have heard the term Robin Hood traders. There's a lot of them in there that have lost their job and are trying to trade for the first time in their life, have little idea about what they're doing, and they're trading on sentiment, they're trading on rumour, they're trading on social media platform information. You think about what they might do if this support level breaks. That's the bit that's exercising my mind. So that's why I think it's appropriate at the moment in the precious metals market just to adjust your exposure, sit back and wait. There'll be great opportunities. They will come. We just need to be a little bit more patient. While I'm there, I should also look at, of course, GDX. So what are gold stocks actually doing? Well, pretty much the same as what we're seeing with gold itself. So they're not really giving me a lead either way. Often, in fact, most of the time, gold stocks will move before the underlying metal does. At the moment, we're not seeing that, and we've just got a triangle formed up in the major gold stocks as well. So really no lead coming from that direction. So the bottom line on precious metals is that if we do get a washout, we may not, but if we do, it'll set up a great buying opportunity. So you want to be ready for that one. Now, turning to other commodities, copper keeps edging higher to $3.10. And BHP, who's one of the world's biggest copper miners, sees that there's going to be new supply coming into the market, and that new supply is probably going to keep a lid on prices through to about 2024. But then they see prices going probably significantly higher from there as demand outstrips supply, because there has not been enough pre-investment in the market. And sometimes with the really big copper mines, you're talking a decade from when you start making a major investment to actually being able to produce. So the outlook for base metals and most other commodities, with the exception of oil, is pretty good, but we may not be quite at the takeoff point yet. Now, crude oil was pretty volatile again, but it's been all over the place the last couple of weeks. So we're up around 43, we dropped to 36, and now we're back to 41. And this was a comment made by BP Oil, which I think is very relevant for the sector and very relevant for those that are looking to try and buy into the sector. And just recently I've had questions about buying into Woodside, buying into Beach Petroleum, buying into Santos. And I think I pretty much give everyone the same answer. And that is that the odds just aren't with you. Why buy into a sector that where the probabilities are not favourable? So this is what BP said: oil consumption may never return to previous levels, with the most optimistic outlook being for flat demand for the next 2 decades. So you compare that to what we're seeing in, for instance, the 5G area, and it's pretty simple where you want to put your investment money. BP also plans to shrink their oil and gas output by 40% over the next decade, and they plan to spend $5 billion building a very large renewable power business. So that's where the world is going. Whether you agree with it, whether you like it or not, that is what the majors are thinking about. And so when you're thinking about trying to buy into the energy sector to perhaps try and achieve this mythical balanced portfolio, it's, to me, it's just misguided. Sure, get diversification in your portfolio, but just diversify in all the sectors that have got tailwinds. Why diversify into sectors that have got headwinds? There's the spot copper chart, so you can see we've come up very steeply from the March lows, and we're still advancing. So copper is certainly improving. I thought I'd just revisit nickel. So the nickel price has just stalled a bit over the last few weeks, but the outlook for nickel is pretty good, and at that level, it's a profitable undertaking. So wrapping things up. Don't take your cues from the indices, as I know many people still do, because that's what the media feeds you. I have to shake my head and laugh at some of the reporting that I see on the news, on the mainstream news, about what the Australian market has done that particular day. And to me, it just screams that the person who's doing it has little idea of what they're talking about. So don't take your cues from the indices. We're not trading the indices on most occasions. We're trying to make money in individual stocks, and we're seeing markets just incredibly bifurcated, operating in two very, very different ways. We're seeing extraordinary progress being made in so many areas: 5G, biotechnology, automation, renewables, just to name a few. It's just such an exciting future we've got ahead of us. Now, there inevitably will be highly risky stocks that you could lose a lot of money on. So one way around that is not necessarily to go with, high-risk mining stocks or high-risk technology stocks that are developing new technology that may or may not work. Why not focus on what I would call the enablers? Focus on the picks and shovels stocks of the gold rush. So focus on the stocks that are selling things that are indispensable to those particular sectors. And I've been rolling those out through my member services. So there's some tremendous opportunities there that where the growth in the business looks highly certain. So investors can generate, when I say highly certain, highly probable is probably a more appropriate word. So investors can generate large gains without taking a lot of risk. That's the bottom line. I think a lot of risk exists in traditional stocks. Stocks like the banks and Telstra. I think there's more risk, a lot more risk in some of those stocks than there is in some of these new economy stocks. Yes, the new economy stocks might be more volatile in the short term, but again, as I said earlier, just develop a game plan that allows you to deal with it. Don't exclude yourself from the sector because you're not quite sure how to play it. There are people out there that can help you with that. Now, portfolio analyst this week, again, it's really not probably doing a lot, just positioning for the next phase, but there are some very exciting opportunities, and there's a couple I want to highlight this week as well. So that's it for this week. Anyone that wants to find out more about what services I provide, there's information on the website, and there's my email address as well. I'll be back with you next Sunday. Cheers.